Jamie, what's the name of the company
Legacy investments and real estate.
and what is the real estate part of it? I- Is that the DST part or is that the,
As a company, we are securities licensed professionals and we
yeah.
specialize in real estate securities.
Okay. So real estate relates to the real estate securities, not like commercial projects or, well,
In this iteration of the company, correct. We are not real estate agents. We are not real estate brokers. We're going to refer them to you if they want to buy or sell a traditional property. You might recall that the origin of our company is, however, traditional real estate brokerage. My dad was a real estate broker
okay.
and was working on large 1031 exchanges, and he's helping someone sell a farm often because we're from the Central Valley of California, Fresno. And then he's helping them buy net lease commercial in a 1031 exchange. And he, time and time again, had clients with boot, unallocated leftover cash in their exchange.
Yeah.
And in many cases, it was hard to place that because it's usually a smaller amount, maybe not enough to buy, especially not enough to buy another commercial property, and maybe not even enough to buy a rental home.
Now,
And
Jamie, when you say a smaller amount, do you mean 10,000 or do you mean 150,000?
I mean, even $300,000 can be hard to place,
Yeah.
Correct.
but it could be much less. It could be 30,000.
Right.
So my dad had those situations a lot as a commercial real estate professional and didn't really have a solution for it until a client of his said to my dad, "Don't worry about it, Patrick. There's this thing called the Delaware Statutory Trust, and I'm going to use that for my boot placement." And my dad said, "What the heck is a Delaware Statutory Trust?" This was about a decade ago. And from there, my kind of the light bulb went off for my dad. He learned about Delaware statutory trusts, got his securities license because that's required to broker a DST
Right.
investment.
Re
And
really quick, what securities license is required for a DST? Just
there's a couple different pathways, and I think it depends on what you want your business to look like. Are you going to be a full-fledged wealth manager, financial advisor, in
right,
which
right.
case you're going to want to do your SIE exam and your Series 7 probably.
Okay.
There's kind of a shortcut path, which is what I took. So I'm not a financial advisor by definition. So this kind of mini designation pathway is the SIE, a Series 22, and a Series 63. So it's still three tests. It doesn't sound very mini,
Right.
but that is actually kind of a simpler path to licensing.
Okay. Okay, so your dad had this extra capital. He
Hmm.
found the DST,
Hmm.
got licensed.
Hmm.
Go ahead.
So he was dual licensed. He had his real estate agent's license and now his securities license. So he could talk to investors about traditional real estate ownership and a DST.
Right.
However, my dad quickly saw that there's a lot of real estate agents and brokers in the world and many that are great at it. There were very few Delaware statutory trust specialists.
Right.
So, about 8 years ago, he decided to focus this company not on traditional real estate, but specifically on these real estate securities. So that's
Right.
how the name real estate or why the name real estate is a part of our company name. We're
Right.
giving real estate investment advice. We're helping our clients invest in real estate, but they're these real estate securities like a Delaware statutory trust, not traditional real estate ownership like what you, Mike, and you, Joel, are experts in.
Right. Right. And our expertise is residential, long-term residential investments, which is probably even different for most of your clients. I would assume that many of your clients come from the commercial side. Is that
It's
correct?
it's
Or
both. A lot of our clients are single family rental home owners.
okay.
Maybe they own one, maybe they own 20.
Hmm.
And then we have the commercial property owners. For example, the farmer and maybe the dentist or the lawyer who bought the office building that they occupied for many years and now they're retiring and selling the business and the real estate.
Right.
So we have a lot of clients who would be your client. And it's really, I think collectively, our expertise here on this call represents the whole life cycle of a real estate investor.
Mm-hmm.
I am of the belief that many people will benefit by starting their real estate investing career or path with you, with traditional ownership, with buying the home, being the landlord, putting in the sweat equity, making the decisions. For many people, I think that's the right place to start.
Mm-hmm.
And then there's decades in between starting with you and kind of ending up in a meeting with me. And that's probably what you see a lot, people taking advantage of 1031 exchanges, exchanging up, acquiring another property and another and another. I'm not really involved in any of that. It's
Right.
you, it's the investor client, it's the qualified intermediary, it's the lending team, it's title escrow, it's the property manager, etc. I really step in when that investor, typically later in life, and is like, I'm so happy with what I've done. I've built wealth, I've diversified my investments,
Right.
but now I want to simplify. Now I'm older. Being responsible for these properties is no longer a fit for their lifestyle.
Mm-hmm.
Often we see that later in life. And then also financial objectives start to change. What I see a lot is an investor transitioning from like growth oriented financial goals to income oriented financial goals. Like, how do I pivot? How do I take this capital and invest it in a smart, kind of risk appropriate way for predictable monthly income? That's really where I see people looking for solutions. And I see Delaware Statutory Trusts being a great solution for a lot of people in that situation.
How many, it requires a sponsor, correct? That is for the Delaware Statutory Trust. There's sponsors who find the investment, so they put the investment together, they gather the capital, purchase the investment. I
Correct.
mean, that's how it works, right?
Correct. When I first started in this business in the Delaware Statutory Trust space about a decade ago, nobody knew what a Delaware Statutory Trust was. And that's
Mm-hmm.
hard when that's your business. You're trying to explain it to people. We're seeing a lot more people aware. Um, so I find myself now talking less about what is a DST. DST is short for Delaware Statutory Trust, and more so about how does this work? Who's who? How do I get guidance on these investments? So the question you asked, Joel, about who's a sponsor, where do these investments come from? That's where a lot of my conversations start with a
Yeah.
potential investor. If I may take a minute to explain who's who, um, my role, this isn't a technical title, but I would consider myself a DST broker.
Mm-hmm.
A client or an investor is going to come to me and they're asking questions like, what is a DST and is it right for me? And I'm going to help them navigate that question.
Jamie, I think that's a great description. Uh, just because you're not pitching one or two DSTs, you look at as many as you can find and then qualify them and say, hey, I think this is the one for your situation. This one's probably going to fit best. And
Exactly.
much like a broker does, whether a
Yep,
loan broker or a real estate broker.
exactly. So through me, you and your clients have access to this vetted list and inventory of sponsors. So I'm not the DST sponsor.
Right.
I'm unaffiliated with them. I'd say, there isn't a conflict of interest. I'm going to sit on the side of the table with the investor and I'm going to help them look at this inventory of investments brought to us by sponsors to objectively say, hey, this is a company I know and like, here's their track record, and here's their current DST investment option, and I'm going to make recommendations. The sponsor is really essential in all of this because they're the ones who bought the real estate, are going to manage it for our clients, and who are ultimately going to sell it. So their expertise in real estate investments is essential.
Hmm.
Their reputation, their track record, their client relations, their communications, all of that's really important. So, me and my team, a big part of our job is making sure we're partnering with the right sponsors who we know will do right by our clients.
How do you qualify a sponsor? That is, what are the questions you're asking yourself? And for example, when I'm talking to another real estate agent that I'm considering in another part of the country that I'm considering referring a client to, and I want to know that they understand their stuff, I ask certain questions. Like what's the cap rate on a property, which is usually
Mhm,
not known by regular real estate agents, but an agent that works with a lot of investors will completely understand that, or a gross rent multiplier. I also ask, what their experience is and how, things that I in here. I know there's certain key things that people who know their business in the industry that they'll understand it. But then I'm also looking for how they respond to certain questions,
mhm,
because there's kind of the inexperienced response, and then there's the more in-depth response from people who've had their teeth kicked in a few times.
mhm.
What does that look like for you guys with a DST sponsor?
Yeah, great questions. Uh, there's there's some really objective um, kind of components to approving a sponsor,
Right.
and then there's some subjective. It's quite a process to become a sponsor approved on my platform, is
Right.
what I would call it. A lot of the vetting and approval is done through my securities broker dealer, which is great. Our broker dealer has a full-time due diligence team, and they're interviewing sponsors. There's a lot of questionnaires. Um, and again, that's more the objective components, and
Right.
that is track record, and it is who's your C-suite. Um, what is your investment thesis? I
It-
tend to go ahead.
Jamie, isn't it partly because of what type of project it is, whether it's an apartment complex, an office building, a medical building, storage units, warehousing, all those different types of projects. And then the client can work with what they know or
Hmm.
understand and feel more comfortable with. And then once all the numbers are run and understand the track record of everybody involved and the sponsor, that's how you go through the process with the
Hmm.
client, correct?
Hmm.
Yeah.
Absolutely. If we think about, my responsibility, what I feel my responsibility is to our client is to make sure this is the best option, DSTs, as compared to other options they're looking at, such as exchanging into another rental property or maybe selling and paying the taxes. Once we've determined DSTs are the best option, yes, it becomes more about which DSTs, which
Mm.
property types. Is it the apartment building, the self-storage, the industrial, with which sponsors? There's a lot that goes into that conversation. It's where I spend most of my time with my clients, but I'm going to marry their experience, their thoughts with mine, and we're going to collaborate. When I meet with the sponsor, I have my clients' goals in mind. And what our clients typically want is they want to complete a 1031 exchange.
No, no, really quick, Jamie. When you meet with a sponsor, are you saying, because I know that you've already looked at the sponsors long before you ever get the client. So are you looking at, is what you're saying there that you're talking to the client, analyzing their risk tolerance, what they're trying to do, what their experience is, and then you go out and interview sponsors after that of like, okay, these are the three people, the three sponsors that I think could fit, or are you doing it a different way? Like,
It's more the inventory I have available is perpetual.
okay,
I have,
because
and it's
that always
replenished.
changes. Your inventory always
Yes.
changes, right? Yeah.
Yes. So the inventory I have available to my clients at any given time, it might have 30 DSTs.
Okay.
So I'm always studying and understanding those 30 so that no matter when a client calls or has a need, I'm already quite familiar with what I've got available. And
Right.
then I'm gonna blend what I know about this client to find the right match in my inventory.
Right.
So I don't need a client to be kind of understanding my properties. Um, when I look at a property, I'm thinking, what is this property as an investment likely to deliver? Different property types might be better at income or growth or both, or tax efficiency of income. Every property is a little different and might deliver slightly different results.
Hmm.
So I'm kind of keeping that in mind so that when I have a client, I already know it's pretty easy for me to say, great, for this client, these few things are going to be the best fit.
Right.
In terms of the conversation I have with the sponsor, I love asking them, why did they buy this property? Why do they think they paid the right price for it? How do they think they're going to manage that property to generate income? Because that's what most of my clients want is monthly income. So what is
Right.
the sponsor's business plan for generating income? And then how do they think they're going to sell this property profitably within about 10 years?
Right.
I have my opinions on how to do that. I want to know how they're going to answer that question, and then we'll see if we're syncing up. If they're over promising, I don't like that. I want to see decisions rooted in reality, backed by data, backed by what's going on in real estate markets and the economy. Because
Yeah,
just
yeah,
because,
I love that because that's what I do the same thing. It's not like a trap.
yeah.
It's just I'm trying to gauge how experienced you are in
Hmm.
this and
Hmm.
how much of the marketing you're giving me versus
Hmm.
how much of the insight you're giving me.
Hmm. Hmm.
Yeah, no, I love
Absolutely.
that. I love those questions.
Because we're accountable to our clients after they make the investment.
Yeah.
We do have, and this was important to me when I joined my dad in the business, was that we wouldn't be a firm that was just transactional.
Okay.
We have an ongoing relationship with our clients, and if at a later date the investment shifts in some way, maybe the cash flow changes, which can happen, I have to answer to that. And I am not the one, recall, I'm not the one managing the property. So now I'm in conversation with our client, who's the investor, myself, and the sponsor. And it's just like, what's going on? Why is it happening? And what are you doing about it? So
Hmm.
I become an advocate for our client to make sure that our sponsor is accountable to our clients. And the good news is because we vet our sponsors, in most cases, if something doesn't go according to plan, it's not usually a fault of the sponsor. It's more so just the reality of, real estate markets and the risk inherent to real estate. But we consider ourselves an accountability partner to our clients, and we're going to make sure they have answers and information for the life of the investment.
So are you saying that if there's a problem, then you're actually reaching out to the sponsor and getting more in-depth responses than the consumer themselves as part owner in the property will get?
Mhm.
I mean, part of it is you have more experience with it. Like if I have a DST, you're going to know more about it than I will. They can give me an answer, but I don't know if it's the right answer.
Mhm.
And by that is, yeah, that's really what should have been done, or if there were things that were
Mhm.
missing in between, things like that.
Yeah. Because you'll probably agree, Joel, when things go wrong, that's where you really see character and
Yeah.
expertise shine. So most sponsors should be good at proactively bringing information to us and to the investor if things deviate from the original plan. They should be communicating proactively,
Right.
and good sponsors do. But if you have a client who's feeling a little more anxious or has additional questions, I have people's cell phone number. I know who to call. I know how to get answers. I know how to help make sure that the client feels informed, um, and feels clear on what is happening. Because usually if something's, and I don't like to say go wrong because I wouldn't even say it's going wrong, but usually if things are deviating, oftentimes the client just wants to know, is this going to get worse?
Right.
Am I waiting for the other shoe to drop? So that's where I find myself jumping in to facilitate conversations, is really making sure the client understands what's going on and what might happen next so they can plan, so they
Yeah.
can sleep peacefully at night and, adjust their budget or something like that if need be.
Now, Jamie, I want to dig down more into this because we're talking about problems that DSTs have that is not matching expectations. We had an interview with
I
a
was
lender
just going to
recently. They
talk about
sold the
that.
property
Yeah.
and they ended up with a sponsor. The sponsor actually ended up going bankrupt. The property itself was in good shape, but the sponsor ended up going bankrupt. Um, and sometimes you can't see everything, but well, you never see everything. Like that all knowledge is out there. It just doesn't happen. But I have a couple questions first. Like, what is the typical, like what you're seeing now? What's the typical return on investment? Because that's essentially cash flow. Then when you're talking about a deviation, if the return is 2% and they're getting 1%, then yeah, that's a deviation.
Hmm.
And how's it going to be solved? And they're now getting half as much. But what's I mean, let's start with some numbers there.
Hmm.
What are you seeing under DSTs? And then are there any types of properties that are performing better or not? And then let's go into kind of the problems and what's a variation off that you've seen, because I know you've seen lots of stuff since 2022. I'm sure a lot of
Hmm.
things have shifted. All right, go
Yes.
ahead.
Okay, I wrote all those down, so I'll remember to address them all. Cash flow and returns. We have transparency on starting cash flow
Right.
because well, the
It's what it's
DSTs,
already rented for, right?
correct.
Yeah.
These aren't blind pools where you're giving money to a sponsor and they're going to maybe go buy something that's maybe fantastic.
Right.
These are properties, all should be properties that are already owned, deeded, and titled to the trust, occupied with lease agreements with tenants, and generating cash flow. So you should
Yeah.
be shopping from an inventory of deeded, titled, cash flowing DSTs, and therefore you know what the starting cash flow is today.
Yeah.
There is a industry company called Mountain Dell, and they request data from sponsors and publish reports,
Hmm.
including the average starting distribution for all DSTs in the current inventory. And right now, that starting distribution on average is 5%. That's a cash on cash return, meaning every dollar of 1031 equity you invest on average would put 5% in your bank account
Right.
after expenses, after debt service.
Yeah. After a year.
So
Uh,
correct. That's annualized. Now, so
yeah.
they'll take that annual number and divide it by 12.
Yeah.
And typically, you're getting a check every month. Now, 5% being the average means that there's options with lower starting cash flow and options with higher. I will say,
What's the spread? I mean, what's kind of the standard deviation, so to speak, of that?
uh-huh.
Obviously, there's some outliers. Um,
There is a lot in the 4.25% to 5% range.
okay.
Most of what I'm recommending and think is the right kind of risk reward um, sweet spot is going to be 4.25% to 5.
Right.
There are a couple of options below 4.25%, but that's getting less common. And there are several that are 5.5, 6. We've even seen 7.
Right.
You got to be pretty careful with those bigger numbers because if everything else is 4.5 and something 7, it's going to warrant a closer look, in my opinion.
Yeah,
Didn't
immediately
they,
in my mind, I'd think a distressed
Yeah,
area,
yeah,
or yeah,
or
it's really good right now, but 6 months
yeah.
from now, then they
it's a
have
higher risk.
vacancy,
Yeah, it's
higher
a higher
risk.
Higher
Yeah.
risk
risk.
of investment. So
Yep.
most people think when it's investing, the more return you get, the higher the risk is. The more conservative you are on the return, the better and the balanced risk.
S-
And so
eh,
that's a question always. So
mhm.
7% sounds great, but may not be great,
Well, what are the lease terms? Who is the tenant?
right?
Where is it located? What are the loan terms? I'd
Yeah.
say those are some high level questions I'd start asking right away. It reminds me a little bit of, have you ever seen, if you're shopping around for an investment property for your client and you see a marketing piece, we were talking about marketing before, and there's a pro forma cap rate. If you
Mm.
kick
Oh
out
yeah.
every single tenant and if you double the rents and if you manage to find an insurance provider who charges half of what the other guy does, then your cap rate's 8. So you really got to dig into the numbers in a DST investment too, and they're all there for you. A
Hmm.
cash flow pro forma, the appraisal, all of that data should be there, and you got to audit it. And you got to say, okay, the marketing brochure says I'm going to make this much money, but what needs to happen for that to be realized? And that's where you sometimes see some what I'd call, I wouldn't necessarily say they're a bait and switch, but of course the sponsor knows that if you slap a 7% yield on it and everything else is 5, every client that comes to my office is going to say, "Ooh, Jamie, what's that?"
Yeah.
And then we're going to talk about risk and we're going to talk about, hey, that might be a fit if, however,
No,
reminding the client why they called me in the first place, which is, hey, I want a low risk, predictable investment. And then we're going to manage their expectations. And we're going to say, if that's what you want, you probably shouldn't buy the empty strip mall that someone says they're going to fill up with, credit tenants. Let's just stick with something tried and true and proven and stabilized with good tenants currently.
now, when they walk me through when they're doing an initial offering, and let's say it's an apartment complex, um, are they've already bought the building. The sponsor has the financing already on it. Are they using their own capital to purchase, and then all the 1031 exchange is removing their capital from it, or is it worked out a different way?
The property is fully owned by the time it's being shown to investors.
Now, when you say fully owned, do you mean is there financing on these, or is there not?
There is financing on many of them,
Okay.
which I think can be a good thing.
Yeah, I don't think
Um,
there's anything wrong with that. It depends what the financing is, and then the
yeah.
returns are based on the financing terms,
hmm
etc.
hmm
Yeah.
Now, a sponsor, some of them are large enough and well capitalized that they write a check. They write a
Mm,
$50 million check. It's done.
right.
Not all of them can do that, in which case you see bridge financing come into play, or they might have like a private equity fund that might be part of that upfront capital. Um, in either scenario, when an investor comes in, those capital sources get paid
They
off
get paid
or
off.
recouped, replenished, if you will.
Yeah. 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 So, right, that brings in the question, because my question is, what is, um, I mean, the starting numbers shouldn't be a pro forma. They should be, this is how it's performing. It's
Agreed.
not, well, we're gonna, we're 20% vacancy now, but we
Yep.
expect it's going to be 3% vacancy.
Hmm.
I mean, those are pro forma numbers, right? It
Correct.
is at 3%, then this is how it performed. But
Correct.
are those starting numbers on the DSTs? Is that common for it to be really pro forma numbers? Or is it like, no, this is what we're leasing it for? And I would assume, well, go ahead. I would
Well, you
assume that's part of your investigation.
exactly. And you got to check. A good sponsor should have an accurate, defensible cash flow analysis based on current numbers. It is not hard for us as real estate professionals and our resources and our tools to again like audit. Hey, your you put together you, Mr. Sponsor, put together pro forma with 97% occupancy. I have all these reports that show this submarket at 89% occupancy. What's
Yeah, why is
what's
there a
going on?
differentiation? Yeah,
Yeah. So you got to audit it. You got to look at each line item. You got to understand it. Sponsors post COVID, in my opinion, have gotten better at no longer using a more generic pro forma, like no
mhm,
longer just saying 95% occupancy across the board. Property tax rates going up this much. They've done a better job, in my opinion, of putting together pro formas specific to the property type, current markets, in that submarket location. But yes, you got to audit it and you'll notice things and you got to probe. And that might be enough for you to say, I'm not going to recommend this to my clients. There's too much
right.
speculation.
So do you have, does that vary with sponsors? That is, I'm sure you have sponsors you just don't use, and I'm sure you have sponsors that are kind of in the middle, which is, yeah, I like these five, but I don't like these three. And then you have ones that are like, hey, this one's always been good. I
Hmm.
mean,
So of course, like past performance is always going to be uh in my mind and it's not just me and my company. I've got a big team and we collaborate on these decisions and this discussion. But yes, past performance is a part of it, but every single investment needs to stand on its own. Because sponsors, you don't want to see a sponsor get lazy. You don't want to see them kind of rest on their laurels and then you start slacking off on your due diligence because they're a great sponsor and then they're like I'm not saying they do this, but you want to make sure they're not sneaking in some things that if you're not still paying attention you miss.
right.
So every deal, every time, whether it's a sponsor I've loved for years, we're going to look at the deal they have in the marketplace and what they're doing and how they're putting it together. Newer sponsors, you got to look at it a little differently. Like you referenced one who went bankrupt. I'm sure I know who you're talking about. And if we are speaking about the same sponsor, they were newer. So they didn't have a DST track record. So how you vet them is a little different.
Right.
Um, I'm not opposed to working with a sponsor who is newer to DSTs, but it's a little more rigorous and building that trust and understanding right their place in the conversation to my clients, that's going to take a little more work
Hmm.
to get comfortable with them.
Right. Um, So given that those original numbers could be, I mean, you're vetting the original numbers, but nothing's ever perfect and tenants leave, the next
Hmm.
day. Stuff happens, stuff breaks, things like that. Usually when you're talking with a client as like, hey, we have a deviation from what was expected. What are the kinds of deviations you're talking about?
Hmm.
Let's use a 4%, 4.5% return
Hmm.
being the middle between 4 and 5. And is that go ahead.
Well, if we're talking about a multi-tenant property like
Yeah,
apartment buildings, and in a
right.
DST, we're usually looking at properties with 100 to 300 tenants. That tends it's the law of large numbers. If you have a lot of tenants, then some of them leaving doesn't impact your bottom line as much. So I like multi-tenant properties. and we're talking about problems, and I'm getting there, versus a
Yeah.
single tenant property. The single tenant property, the problem is pretty straightforward. You've got one tenant paying rent, and if that tenant goes bankrupt or decides not to pay rent, your cash flow is zero. So in
Yeah.
a
Yeah. Yeah.
single tenant property, your cash flow can go from 5% to zero. There's kind of nothing in between.
Yeah.
So with a single tenant property, you really want to understand the tenant and the lease terms and the lending terms, etc. Multi-tenant properties have so many more ins and outs. The pro forma is different line items for revenue, which is
Yeah.
a function of occupancy and the rent you're charging. And then a lot of expenses,
Mhm.
property taxes, insurance, maintenance, marketing. So there is a lot more that can change the bottom line.
Right. But
Typically,
it seems like that it would require, I mean, there would be a lot of variation, but seems like it would be small variation.
yeah, it is. I'm talking it was 4.5 and now it's 4. It'd be
Okay.
pretty extreme if it was 4.5 down to 2. Going all the
Right.
way to 0 is rare. It can happen. And it's usually the sponsor saying, look, there's we're navigating XYZ. And as a result, we're gonna proactively, ideally proactively lower the distribution so that we can manage cash flow. And there might even be more cash flow than what they're paying out to the investors, but it's going into the cash reserve account. So they have
Sure.
working capital.
Yep.
That's smart. I think that's a smart management decision. Oftentimes, a lower distribution is eventually raised again. We see new supply be a threat to cash flow. That's
When
not
you say new supply, what do you mean new supply? New
3 new
DST supply?
apartment buildings. No. So for a
Oh, you mean
property
competitive supply?
competitive supply in a
Got it.
market. So
Yeah.
you own this apartment building in Dallas, Texas, and 2 new apartment buildings have been built within a 1 mile radius in the past year. That's
Right.
gonna create a supply demand imbalance, and you're gonna see that hit your bottom line
Right.
for a period of time. So now we're looking at new construction and population and demographic information, and we're trying to say, okay, when is this new supply going to be absorbed? Is it going to take 6 months? Is it going to take 3 years? And how is that going to impact our occupancy and the rents we can charge in the meantime? And how do we set, and this is the sponsor really thinking about this, how do we set a
Sure.
reasonable expectation to our investors? And you're going to get an investor letter that says, because there are 3 new buildings in lease up, we have to offer concessions. We have to offer more competitive rents. Our
Mhm.
occupancies, we're trying to keep occupancy high, but as a result, we have to lower rents, which means revenue is down. And we think it might be 6 to 12 months before this evens out and we can resume, you know, rent growth.
Right.
That's what an investor letter might say in so many words.
Sure. Yeah. Now, talking on the appreciation side, because that's the other aspect that I'm sure the investors are looking at, both the cash flow as well as the appreciation over time for whenever
Hmm.
it's sold.
Hmm.
Um, give me your thoughts of the last like 7, 8 years. That is before COVID. What happened to the whole market with COVID? What happened in 2022 with and maybe it was a different time uh, because of the commercial up until now, and kind of where the markets are trending now from the
Okay.
DST perspective.
So now we were just talking about cash flow, things that might impact the amount of money you're receiving on a monthly basis. Now we're talking about appreciation. What we've, this property that you own, what is it going to be worth when you go to sell it? Well, a lot of that is that's determined by cap rates, which is very much tied to interest rates. Bottom line, it's pretty simple. Um, a disadvantage to a DST investment is that it ends, it has a investment period that, in my opinion, is pretty short. On average, it's 5 to 7 years.
Mhm.
None of our clients have ever owned an investment property for just 5 to 7 years. Often, my clients have owned their property for 10, 20, 30 years
Yeah.
because appreciation takes time. And in between, there might be some cycles, but over that longer time period, prices are going up, up, up.
Yeah.
However, when you make a DST investment that is only 5 to 7 years, your back end sales price is much more tied to just what are interest rates and cap rates doing in that 5 to 7 year period.
When you say back end, do you mean the sale price
Yeah.
at 5 to 7 years? Okay.
Yeah.
Back end sales price. Okay.
So if you got into a DST
Yeah.
in 2022, when interest rates and cap rates were historically very, very low,
Mhm.
and now you're in that operational phase of that DST where you're getting monthly checks. But what's happened to cap rates and interest rates between 2022 and today is they've gone up. Now, not a lot, but they've gone up a little,
Mhm.
which means prices have come down. So even a great building operated well is technically less valuable today than it was in 2022 because interest rates and cap rates went up and prices went down.
Mhm.
That is the biggest impact or influence on what the numbers look like when your DST property sells.
Mhm.
We
Now,
in
do they guarantee a sale? And I know it's not guaranteed. What I mean is, if yeah, just like you're saying, I think this is a great example. Okay, from 2022, the cap rates have gone up a little bit. Therefore, the prices have kind of adjusted. And let's say they've gone down 10%, and then you're going to have another 7, 8% in closing costs. Are they just going to say, hey, let's ride this a little longer? Or are they just going to say, hey, we're going to take that 15% hit and, and just sell, here's your money back, less
spon
15%.
sponsors really hate to sell for anything less than putting every single dollar of your capital back in your pocket.
Right.
That's the floor. Anything less than that is not a good look, and investors don't like it. But there can be headwinds depending on what's going on in markets. I have to think about that today. I have to think
Yeah.
about where are things going to be 5 to 7 years? What kind of market are we going to exit in so that I set the right expectation for my clients today and so that I ask the right questions to the sponsors about how are you going to overcome, these market challenges in the next 5 to 7 years. Um, it can be done in most cases. Investors are exiting these DSTs profitably. How profitably, again, I think has a lot more to do with market cycles than it does much
Yeah.
else. Um,
Yeah.
a sponsor, I'd actually love to see longer term DSTs, but investors don't like that. If I told an investor today, even when I tell an investor today, Joel, this is probably a 5 to 7 year investment, it could be up to 10, that's hard for them. Oh my gosh, I can't touch my money for 5 to 7 years. Oh my gosh, I'm passive for 5 to 7 years. We got
Right.
to really work through that. So if I were to tell them it's going to be a 10-year, 15-year, 20-year investment, I don't know that anyone would be comfortable signing up for that.
Right. Just because you can't do anything, you have no control over the investment during the term.
Yeah. Yeah.
Yeah.
Well, not only that, you have to understand how investors think. Right now, you can put money into CDs, T-bills, money markets, all those things, and they're short-term investments. They're returns. They give you a percentage of return. They pay off, etc. So I'm thinking when an investor comes in and looks at the DST, they look at the short term and they compare it
Hmm.
to the CDs and stuff, which
Hmm.
really is not a good comparison. It's just that's just the way they're thinking.
Hmm. You're
So
right.
another question for you is there with the DSTs, there is some tax advantages and we have some tax side of this whole process. You get a K1, you get depreciation, you get a um, debt reduction, you also get expenses, shared out. So speak to that a little bit because that also is a hidden
hmm
return.
hmm You're right. People tend to oversimplify their analysis by saying, Jamie, you're showing me a DST with a 4.25 cash flow. I could get 4.25 in a, 2-year treasury. That is not how that analysis works. So a couple
Okay.
things. Um, the 4.25 treasury has no growth component. Meanwhile, your DST does. So it's 4.25 cash flow with the potential for growth. So your total return in a DST or real estate investment might be higher than just the 4.25 if we sell the property, profitably. So that's one. Two would be the tax efficiency of the income. To your point, Mike, when you own real estate, which a DST investment is, you get deductions, write-offs, and the huge tax shelters depreciation. So you may earn 4.25 in both of these investments, but you're not going to pay taxes on every penny. You probably won't pay taxes on all the money you make in the DST because of the tax shelters, like deductions, write-offs, and depreciation. So your tax yield equivalent is usually, for many people, like a full percentage higher. It's more like a 5.25 yield when comparing it to other investments where you're going to have to pay taxes on all the income. And then more importantly, and we have software that helps us model it, people are coming to us with not cash. It is not money in the bank. It is money, equity in an investment property.
Hmm.
If you want to take your equity from a rental property or an investment real estate property and put it in a CD or the stock market or an annuity or a treasury or money market account, you can do that. But first, you're going to pay all capital gains taxes.
Right.
You're not going to have your $1 million of equity to put into your money market account. You're going to have 30% less because that's what your capital gains tax bill is likely going to be.
Right.
So you're
Right.
going to have $700,000 to invest at a 4.25 yield, or through a 1031 exchange into DSTs, you can keep your $1 million and now you have $1 million earning 4.25. So you have to remind the investor of all those points. They may still love and feel so comforted by the fact that, hey, if I put my money in an annuity, I have guaranteed income. Or if I put my money in a 2-year treasury or CD, I can access it 2 years later. Those benefits might be so meaningful to them that they're willing to pay 30% in capital gains taxes. But for many people, that said, oh, yes, you're right.
Right.
um, 4.25 is not 4.25
Right. Right.
for
Right. Right.
those
Right.
reasons.
Now, what about debt? Doing an
Mhm.
exchange of debt, can
Mhm.
they, if they're using that same $1 million, they have $500,000 in debt and 500 in equity, and they move that whole $1 million over to a DST?
Mhm.
Okay.
So, Joel, because we are with DST investments, most investors are doing this within a 1031 exchange. So we
Hmm.
are following and minding all 1031 rules,
Right.
including the debt replacement requirement.
Right.
So we're going to look at the equity and debt breakdown of the property you're selling to make sure, for purposes of your 1031 exchange equation, that if your investment plan is DSTs, we're going to do two things. If what you want is full tax deferral, we're going to reinvest all net equity
Hmm.
that you net at the close, and we are going to replace your debt by putting you in a DST or a portfolio of DSTs that collectively have in place non-recourse financing equal or greater to the property you sold.
To whatever it was. Now, do they have to actually get on the loan?
No, it's incredible. It's non-recourse, meaning that the investor
Right.
is not having a credit check, does not have to qualify for the loan, is not
Oh, yeah.
personally
Good.
guaranteeing it.
Good point. So it doesn't matter if they're on
Nope,
it or not. How do
nope.
they take part in that? I
So
mean,
do they
what's the
do
structure
they
there?
Do they do like a fictitious name, like a LLC or whatever, and that's how the debt is held, and then they become a percentage of that debt held?
Hmm.
Is that
But
my
the
understanding?
but the fictitious name and the entity, it's not an LLC, it is a DST. It's a Delaware
DST, okay.
Statutory Trust.
Oh, okay.
So the loan holder is this trust that's been created. The title holder is the trust that's been created. Usually the name of the trust, this fictitious name, is like in some way references the real estate it owns,
Yeah.
like the Cottonwood Apartments DST, for example. The investor with their equity becomes a beneficial interest owner. It's like being the beneficiary in a trust.
Hmm.
And
Mhm.
if that specific DST has a loan in on it in place, then their equity not only gets them ownership of the real estate on their equity, but also their pro rata share of the loan that is on the property. So they're going to get some of their ownership from their equity, they're going to get some of their ownership from the debt, and they're going to get a
Hmm.
closing or ownership statement that says $500,000 of equity was invested, $500,000 of a loan is now attributed to your ownership. So you own $1 million of this property held in trust.
So then the
So when the
sponsors hold the balance of whatever the loan debt is
The
yeah,
trust
so
their
does.
ownership.
the trust does, yeah. So in the end, when you get ready to sell, the numbers change. So the actual cash value on the sale, instead of 500,000, it could go up to 700, and the debt reduction could be 300 instead of the original 500. So if you decide to do another exchange, now you've got 700 liquid cash, 300 debt to now replace.
Yes. So
Correct?
you're correct. You may see your equity and your debt numbers change as that property's value changes and the loan gets paid down.
Hmm.
So when that property sells, just like we're doing today with your exchange planning, we're going to look at the settlement statement. We're going to look at that
Hmm.
breakdown of equity and debt associated with your ownership, and we're going to match that in your next investment.
Right. Right. So just as Mike said, it could go from 5 and 5 down to 7 and 3. So,
In theory, it
assuming it sells for
could.
the same thing.
We do see a lot of interest-only loans in
Okay.
DSTs.
Mm,
Um,
I was just going to ask that.
Not always. Many are interest only. Many are interest only for 5, 7, or 10 years with a 10-year term. We do see some fully amortizing loans, and I tend to like those. But now you're looking at things like debt service coverage ratio and how does loan amortization impact cash flow and the risk. But yes, we look at all of that. Um, but yes, in theory, your amount of equity, the amount of outstanding debt could change. So we're going to look at the numbers at the time of selling the DST to make sure we get it right in
right.
your next investment.
Okay. So Jamie, let's go back to what we're talking about. What were the things that you saw in the DST world? 'Cause I don't remember when we talked, but initially, I think when we met years ago, the returns were like 5%. And then when we were talking a few years ago, they were like 3 to 4%. And it's all, market driven.
Hmm.
And now they're 4 to 5%. So what did you see as those shifts? In residential real estate, it was with COVID, and then the market really took off. And then when the interest rates went to 5%, it became unaffordable for many buyers, and so the pricing basically stopped. In some areas, it went down. In some areas, it continued to go up, but the
Yeah.
the returns were just high because we saw a run up from 2020 to 2022, and then really stagnation across many markets in the United States from 2022 till now. And I think we're going to see a different shift over the next
Hmm.
coming years. So what do you see? What did you see with the DST world, and what do you see going forward?
I think some of the impacts of what happened during COVID with really dramatic interest rate changes, both down and then back up, we haven't seen all of the outcomes of that yet
Hmm.
because
Great.
those exchangers, if we're talking 2022, if they exchanged into DSTs, they're 4 years into it. Um, the cash flow, some cash flow things we've seen over the years would be like there's a lot of markets where rents are flat. There's a lot of markets where expenses are going up, like insurance, and
Yeah.
rents are flat. So
Yeah.
if your expenses are getting higher, but your rents aren't getting higher, we are seeing some of over the past year, we've seen these announcements that cash flow is going to be lowered. Again, nothing that really distresses me, but making sure the investor knows, hey, it was 4.5 and now it's 3 in terms of cash flow. Um, so we've seen a bit of those letters come out. Hey, we're lowering cash flow. In terms of sales price and total return, we don't know yet. It's um
Too soon to tell.
Yeah, too soon to tell. I think it's fair to say these might be hold periods on the longer end
Hmm.
because we kind of lost a few years in terms of rent growth and
Yeah.
dealing with these rising expenses. So what might have made sense is like in terms of a profitable sell, in normal times is maybe delayed. I'm expecting longer holds to kind of make up for some lost years in terms of revenue growth. Um, but I don't have any big worries. We we diversify, try to
Hmm.
diversify our clients, and that's a huge help.
Now, when you say diversify, what's a typical diversification strategy for a client?
hmm hmm It's going to depend on the size of their exchange and their
Hmm.
total net worth. The
Hmm.
minimum investment in a DST is typically $100,000.
Okay.
So if you have $1 million exchange, technically you could pick up to 10 DSTs.
Hmm.
If you have a $200,000 exchange, you can pick up to two. So one is how much equity do you have to invest? Um, I like to look at the that specific investor's net worth. Do they have $1 million net worth or do they have a $10 million net worth?
Hmm.
Because the amount you invest in any one DST, is it 1% of your net worth or is it 10%? And that's different for different people.
Right.
So I like to talk about diversification in terms of your net worth and how comfortable are you having 5 or 10% of your net worth in any one property and then kind of doing the allocation amount based on that. And then other things I like to look at are you going to have future exchanges into DSTs?
Hmm.
Because I can tell you right now, you do not want 20 DSTs. There's this
Okay.
sweet spot between being diversified as a way to lower risk,
Yeah.
but do not overcomplicate it. Do not make your CPA's life,
Suffer.
um, yeah. Um, Even, imagine like people who do have a different CDs. If you have 10 of them, you're just like, okay, when does that one come due and which bank is it at? Like there is some tracking you
Yeah.
got to do and you're waiting for your tax documents and you're waiting for your investor report. Like you don't want 20 DSTs.
Sure.
So those are some of the things that we navigate with our clients to help them generate the benefits of diversification as a way to lower risk, but not overcomplicate their investment plan.
Hmm. Yeah. So if you have $2 million, you could diversify into three or four DSTs at three or $400,000, or even what, 600,000 in each one.
Hmm
And so do you diversify across property types as well?
Yes.
Like
hmm
I would assume the basic diversification is, your amount diversified in different things, but also the location and the type of property
hmm hmm
and
And the
possibly sponsor
sponsor.
too.
hmm
Yeah.
hmm hmm And we do that for a lot of reasons. A call I was on this morning, our preliminary plan is probably to do a combination of an apartment building with an industrial property.
Hmm.
The industrial property has a credit tenant, long-term lease, pre-negotiated rent, rent schedule. That's more of your fixed income investment. Those tend to be less good at growth
Hmm.
because your rents increase. You've pre-negotiated this modest annual rent increase, but that's kind of a pretty reliable fixed income
Yeah.
property type. The other part of the investment plan is going to be a large apartment complex where technically, there's more potential um, risk to your income because it's based on occupancy and revenue and expenses, but there's also more potential for growth and upside.
Hmm.
So they just work really well together.
Right.
Um, one is more income with less growth, one is still income oriented, but more variables, but has that upside potential. And to have them both in a plan together, they just play off of each other really well.
Right. And so with your past clients, your recommendations, what number do you not want to go over? So if you have that $2 million, you don't want to buy 20 different DSTs. And
Yeah. Um,
but it is like three or four okay. We were running into kind of the same thing with property. If you have 20 properties, that's great. If they're all in one area, that's great. If they're in three areas, that's great. If they're in 20 different markets, then
yeah.
that's probably not great.
Yeah. What I like to do is I like to start with a smaller number. Let's say it's a $6 million exchange, and I'm going to
Yeah.
do an illustration with four DSTs at $1.5 million each.
Okay.
I'll do an illustration, and then in a Zoom call with a client, I'll just put like a red line through one of them, and I'll say, imagine the absolute worst thing has happened. An asteroid hit this building, and yes, there's insurance, but you're going to have no income for a year, year and a half, and we don't know what that property's value is going to be.
Hmm.
You still have three other investments, and they're doing well, they're doing fine. So now let's imagine, let's look at what does it look like if you're living off of these other three investments without this one. How
Right.
much does that hurt? How much does that scare you? How much is that going to leave you lying awake at night? The numbers talk, and an investor will say, yeah, that feels a little too exposed. Let's do an illustration with six. Or they might say, no big deal. I mean, one, I don't think that's going to happen, Jamie. And two, that's still plenty of money. We don't live off of this money, So
Right.
I'll walk you through the what if. I'll walk you through the worst case scenario, and then together we'll kind of start to see that sweet spot of how much equity in one investment's feeling comfortable
Right.
for the
So it
investment.
can just be comfort with regard to
Oh
that.
yeah. Oh yeah. I think that is what it is.
Yeah.
Um, these investors, they don't want to be hands-on anymore. They're really trusting me. They're trusting the sponsors. I think it's absolutely about comfort. What's going to make you sleep well at night? How many, where, what, with whom? How do we answer those questions so that you feel comfortable and you sleep well at night knowing, hey, I'm not in control. There's risks inherent to real estate, but I feel well diversified. And I know that even if something bad happens, I'm covered. It's
Right.
not going to be the worst. It'd be really hard to lose all your money. Technically, could it happen? But I like even in the bankruptcy example of another sponsor, investors, I don't expect them to lose all of their money. Um, we've
Yeah.
seen,
Well, you still have a producing asset. So
yeah,
even though the sponsor may change or may restructure or whatever, you still have a producing asset that
yeah.
is,
Or
it's
they may
real estate,
force
it's
the sale.
tangible,
And they
it
may
could be
force the
sold.
sale. Yeah, they may force the sale in the
Yeah.
bankruptcy, and then there's a payoff to that.
Hmm.
It could be a par, or
Hmm.
it could be slightly less, but it's
Hmm.
not losing
It doesn't go
100%.
away.
It's not
Yeah.
zero. And hopefully those clients were diversified when they made that investment, and hopefully they have one or a couple other investments that are probably doing just fine. So it
Yeah.
is
Just what
not,
you said. That's
yeah,
exactly what happened.
yeah,
They have multiple and all the
yeah,
others are doing great.
yeah. And again, I'm not saying that's good, that's bad. And I think the investor has every right to feel a little kind of shook up by that. It's really important to reflect on what happened, why, and what can be done about it going forward. I hate to see those things happen because it's easy for people to associate bad outcomes with all of DSTs.
Right.
And I don't know that that's accurate. Um, so again, That's why my role is really important. Let me share with you what I know, what I've seen, what my knowledge is, and make sure you really understand what this DST world is like so that, you, the investor, can use accurate information to make your decision.
Yeah, make an informed decision.
Yeah.
Another real quick question. When I talk to investors or whatever, and you see this on the news and the TV, they talk about being an accredited investor,
hmm
um, and what that really means. So I've asked that before. What is an accredited investor? I'm not sure. I don't think you need to be accredited investor to invest in a DST. Um, an accredited
Current.
investor, by definition, is you have to have $1 million net worth.
hmm
Correct?
hmm Yes.
Yeah.
Exclusive of your primary residence. There is an income or there is an income qualification. So it's or, not and. So either the $1 million net worth exclusive of your primary residence or income of $200,000 a year if you're a single filer, 300 if you file jointly. And yes, currently you do need to be an accredited investor the way that DSTs are regulated and distributed. That syncs up pretty well with, a retirement aged investor who's been invested in real estate for a while, especially in California with California property values. We
Yeah.
typically see California landlords quite easily um, qualify as accredited. But occasionally I get a call from a younger investor, 45 years old, teacher, bought a rental property, kind of liked it, but also kind of stresses them out. They hear about DSTs and being passive, and they're like, that sounds great. I'd love the benefits of the real estate ownership without the responsibilities. Tell me more. Sometimes in that case, younger, still working, still accumulating wealth, they may not yet be accredited, and I do have to let them know I won't be able to work with them. But the industry is evolving and changing, and how accredited investor is defined is also evolving. We could see some changes to that in the future.
Right. So it seems like most
It-
of your clients would naturally be headed towards retirement or already in retirement. Is that accurate?
Yeah, and that doesn't mean there isn't a different profile for our investors. I think that the three areas I like to focus on in a conversation with the client is financial. What are your financial objectives? I do typically see DSTs be better at income than growth. So if growth is their priority, they may be better sticking with the rental property. Um, Lifestyle. A younger investor doesn't mind getting phone calls, getting on a ladder, dealing with tenants, dealing with vacancy, writing a check for a new water heater. But an older investor wants to go on a cruise without worrying about a phone call.
Yeah.
There's also I see a lot of couples where like the spouse manages all the real estate and the other spouse doesn't know a whole lot about it.
Hmm.
And they start to wonder, well, what happens if spouse one gets sick? And the other
Right.
spouse is thinking, what do we own? Who are our tenants? How do we pay the bills? Um, so that leads a lot of people to calling me. And then estate planning is big. How do you transfer the wealth you've accumulated simply and without burden to the next generation? And that's another area where we see DSTs, which is real property, but to you, the investor, it's really just paper. So if something were to happen to you as the owner of a DST, when you pass, nobody's dealing with tenants, vendors, bills, deeds, county clerk's office. They're just calling me and we're just
Right.
updating paperwork.
Right. Yeah. What are the fees inherent in DSTs? For example, in
Yeah.
real estate, we charge a commission to sell. Um, Usually the commissions are paid on the sell side. But if somebody's buying, there's usually they're usually paying a lender.
hmm
So, and, title escrow fees, but what is it on for a DST?
There are more fees in buying and selling a DST investment than there are in traditional real estate, primarily because we're putting the investor in the passenger seat and other professionals are doing all of the work.
Okay.
The due diligence, the marketing, everything that goes into buying, managing, and selling. The good news is these fees are not out of pocket. They are built in, they're exchange eligible. You're not going to write anyone a check. What
So they
can,
come out at time of purchase or at time of sale, and they just come out of the escrow process.
yeah, they're built into the investment.
And they're
It,
deductible too, right?
mhm, mhm,
Yep.
mhm. Really what I think the investor should know, again, they're not writing checks. They, in a way, they shouldn't really even notice them, but again, they exist. What an investor really needs to know is that they're paying a premium price for the real estate because it
Mhm.
has these costs built into it, which means it needs to appreciate a little bit more than had they bought it directly on their own before it's in the black,
Okay.
before its value has kind of overcome that load. That's part of the reason why growth on your invested equity is can be modest compared to buying something on your own, is
Right.
because a lot of the fees that are built in are essentially paid for through the future appreciation of the real estate.
Right. Well, and what is it? I know that I've looked at some, and this is over the last couple of decades. And not DSTs. I don't know what they charge, but some other syndications would be 3% or more to whoever's the syndicating organization. What is it in DSTs? Like, how do you guys get paid?
Hmm.
How do the syndicators get paid?
Hmm.
Uh, I'm sorry, it's not. Yeah,
Sponsor.
the sponsors. Thank you.
Hmm.
How do
Hmm.
the sponsors get paid?
So, if you look at the balance sheet of the trust, what does the trust own? Therefore, what does our client own? They are going
Right.
to own a piece of real estate, and then there's going to be a bank account with some cash in it, and that's what the
Right.
client owns.
Okay.
So, what I like to do is I like to look at the value of the real estate. I look at an appraisal, and then the balance of money in the bank. So, that those together might have a $100,000 price tag. So,
Mhm.
your client is getting something worth $100,000 on day one, but they're
Right.
not going to pay $100,000. They're going to pay fees that are tacked on. And that load, if you will, that premium, is composed of those line items you just laid out, my commission, the sponsor's acquisition fees, and then some due diligence costs and some trust structuring costs like legal fees. There's industry norms that we look at to make sure each line item is within industry norms. Some sponsors do a little more here, a little less here, a little more here, less, right? So we look at each line item and then we add them all up. It wouldn't be unheard of for that load to be anywhere from 7 to 15%, with
Mm,
10% being a number you'll probably hear pretty commonly. So it's like a
okay.
10% premium price for this all-inclusive turnkey real estate program.
Now, I, sorry, I'm breaking in because I know you've got more, but I'm trying to understand it. So the way the prospectuses that I'd read, the syndications, that basically is that you're paying $100,000 and you're not paying 110 for that $100,000. What you're doing is you're paying 100 and you're getting $90,000 worth of product that is
Yeah.
property or loan or whatever. Okay. So it's
Yep.
it's designed the same way so that it's not an extra additional fee over and
Hmm.
above that is, okay, here's my $100,000 in exchange funds. By the way, come in with 10 more.
Hmm. Yeah.
Okay.
And that's intentional. That's to help people avoid out-of-pocket expenses. It's
Yeah,
it's
yeah.
also done kind of in tandem with satisfying your 1031 exchange. But there's no way around it. It is a premium,
Right. Yeah,
purchase.
it's what allows it to happen
Yeah.
so that you can
Yeah.
be hands off
Yeah.
and not have and get a return. And so it makes total sense of why the appreciation be less
Hmm.
because you're getting the cash on cash return.
Hmm.
Now when they're doing the estimated returns, are they factoring that in? So if you're putting in 100, but you're actually getting 90, your 5% return, using that as the arbitrary number, is you're getting $5,000 on that 90% of value. So your return on the value in is actually higher than the 5%.
The cash flow yield is a cash on cash return. So if $100,000 is invested, your 5% is calculated on your 100,000.
Okay, so that's calculating in all the
Yeah.
fees
Yeah.
into, okay,
The math is simple and user friendly as
yeah.
it should be. I want to, and I do in my meetings and in we have software that'll, do portfolio illustrations for our
Right,
clients.
right.
It's literally going to show you what your first check when you log into your bank account and see a
Mhm.
deposit, it should be this much.
Right.
We because that's again, a lot of people are doing this for income and they want to know what's going to go into my bank account. And I don't want to tell you you're going to get a $500 check and then you only get a $400 check.
Yeah.
We want to set the right expectations. So again, you
Yes.
make the right decision.
Got it. And then on the sale, how are the fees in that? How are they factored in? I mean, okay, I have a property, I sell it, then there's all the commissions, etc. Everything closes out. I get whatever's left over.
Mhm. It's
Uh,
similar. And
okay.
and most of the fees, at least the bigger ones, are upfront at the structuring of the investment.
Right.
The sponsors do often have the right to take a disposition fee, which is sort of like a pat on the back to them for hopefully doing a good job. We like to see that disposition fee be appropriate for the results. So
Right.
you'll often see in a PPM, we reserve the right to take a 1 to 3% disposition fee. And if they
Uh,
did
uh,
better,
do they tie that to, if it's appreciated more than 10%, we'll take X. If it's appreciated more than 20%, then we'll take
it won't
Y, or
explicitly say that in
yeah.
part because they kind of can't. We have to be careful that because these are not partnerships, these are not
Mm,
LLCs, and we got to be careful that they don't like kind of look like that with like a
okay.
waterfall or preferred return.
Right.
So it's more just, hey, at the end, we have the right to take a disposition fee of a range, from 1 to 3%. And then what you should see as a sponsor, choose a disposition fee at the time of sale that matches the outcome. And the better the outcome, the more appropriate it would be for a sponsor to take their disposition fee on the higher end of that
Got it.
range. And then the reverse should be true too. We sometimes see sponsors waive disposition fees if the outcome isn't great. I think that's appropriate. I love to see that. I
Yeah.
love to see the sponsors um do right by the investors.
Right.
That's
Now, do you guys get paid at the sale out, or do you only get paid at the buy-in?
only up front.
Okay.
Currently, now we're seeing some evolutions in the DST kind of distribution space in
Uh-huh.
that more and more financial advisors, again, that like wealth manager at Morgan Stanley, LPL, Fisher Investments, we're seeing more of them start to integrate DSTs into their management practice.
Right.
And how they charge a client could be different. It might fall into more of a wealth management model where instead of an upfront commission, that
Hmm.
financial advisor's kind of putting this in the bucket of this is the money I manage for my client, and I'm going to collect a 1% annual management fee.
Right.
So
So
for
the sorry, I'm reading into this, but
mhm,
it could be, instead of 10%, it'd be the fees. Maybe it's 8% on the upfront fees, but then it's a 1% annual of
yeah,
the cash flow.
yeah, yeah.
Okay.
Isn't
So
that kind of
an
like what Fisher Investment does? They take a percentage of how well you do or how little you do, and so they go along for the ride also
yeah,
with the investor.
correct. And there's some pros and cons to different fee arrangements, I would say, but a majority of these investments are going to be brokered through a professional like me where the compensation model mimics more of a traditional real estate transaction, which is I don't invoice you. I don't send you bills. If I help you buy real estate, the
Mhm.
DST, I will be paid a one-time commission through the DST. You do not write me a check. It's part of the investment. And that compensation I receive is designed to motivate me to be there for you for the life of the investment, take care of you, service you. And then when you have another 1031 exchange or when the DST you've invested in is selling and you have the opportunity to make a new investment, hopefully I've done right by you and you want to work with me again.
Mhm.
And then I would have the opportunity to, if you make a new DST investment with me, I have the opportunity to then again make another commission. Just
Mhm.
like if you do right by a client and they call you again a few years later and say, hey, help me buy something else.
Correct. Yeah. Now, do you, and by that I mean your company. Is it structured so that Legacy Investments determines what their fee structure is, or is that determined by the sponsors?
Um, Both. It's determined by the sponsors, which is determined by the industry.
Right.
And there's also some legal components. There's some 1031 components that impact how these decisions are made. But there's industry standards. Um, but as you see DSTs become more popular, you see more people come up with new ways. It's ever evolving. We pay close attention to that. We feel there needs to be a compensation schedule that's mutually beneficial. The
Yeah.
investor
Yeah.
needs
Everyone's
to,
got to get paid, and they got to get
yeah,
paid enough to keep doing it.
yeah,
Otherwise, it goes away.
yep. And the investor has to get good service, good product, and a good yield.
Yeah.
And the DST professional, the sponsors also have to get paid enough that they care, that they want to stick in the business, that they're creating inventory and product. So I do think that the current model is mutually beneficial, but I also won't be surprised if it continues to evolve.
Okay. Okay. All right. Question. So let's say, um, I have a theoretical question. Let's say there's a 10 million, and these are not real numbers, a 10 million DST, and there's 5 million in debt and 5 million in equity that's being transferred in. Um, and the sponsor, of the people that join this particular offering, there's the 5 million in equity, which is fully um, fully funded, but the only 2 million of the 5 million in debt is fully funded. What's the um, I mean, where is that debt? Does it keep going, or I mean, is that held by the sponsor, or what
Hmm.
happens there?
Hmm. Um, if it's the loan from the bank on the real estate, that piece is already in play. If you're talking about if a sponsor used any kind of like bridge financing to fund
Well,
the
presumably
equity,
that would all be paid off, but if it's a loan that's on the 50% or whatever, um, it,
every as every dollar that comes in is going to get the prorated amount of debt. So
right.
equity and debt will sort of sell at the same pace.
Oh, okay.
If any of the real estate is left unsold, which is very rare. I mean, again, because it's a lot of work for sponsors, it's expensive for sponsors. And they have a lot of resources in terms of should I be a DST sponsor? We
Yeah.
don't see a lot of people like dabbling. These are experienced, well capitalized sponsors typically, and they're not putting anything in the marketplace unless they know it's going to sell.
Mhm.
Um, and they do. They sell within 3 to 6 months pretty commonly, meaning all of its value's been purchased by investors. There's no
Okay.
more of it to sell.
So there's no more debt and no more equity.
Correct.
And maybe I'm
Sometimes,
misunderstanding how the debt works.
correct. They're going to sell together. it's like buying a slice of cake. Like you
Yeah.
get the cake and the frosting. You kind of don't get to pick, and that's my metaphor for equity and debt. Like it comes
Yeah.
together,
Yeah. Yeah.
and every investor's going to have the same amount of or same ratio of debt on their dollars
Okay.
as
So
the trust.
one last question
Mhm.
on this. Um, and thank you so much for spending time with us
Of
today. This has
course.
been awesome. Um, does the sponsor hold any of the ownership of the asset, or is it completely held by other entities, other
Some
people of the trust?
Sometimes sponsors intentionally hold some, and you know that up front. Sometimes sponsors just hold any last little piece. So it depends.
Okay.
I would say the main motivator for a sponsor in terms of accountability and how do we know they're going to do the right things is their track record. So many investors make these decisions based on a track record. Protecting their track record, building the track record is essential to a sponsor.
Hmm.
Um, Really what they want is they want to earn your trust and you make the investment with them and then they do right by you so that when the DST sells and you have the chance to make a new investment, you call me and you say, Jamie, that sponsor was so great. I don't even want to look at anybody else. Just show me DSTs from that sponsor.
Right.
And
Right.
that's why longevity and commitment to the space is really important. And a factor when we're vetting sponsors is like, are you just here to make some acquisition fees and then you're going to be on to the next shiny
Yeah. Then you're
new
out.
investment structure? Or are
Yeah.
you really committed? And we
Mhm.
want to see committed long-term partners who understand what kind of properties make sense in a DST. They understand what a DST investor is looking for, and they understand how to deliver on the expectations of this typically retirement aged investor.
Yeah.
Jamie, are you hearing anything in the street for sponsors to do whole subdivisions of single family as a project? Are you seeing some of those come across in the
We are.
DSTs?
We
Okay,
are. The build
I
to
thought,
rent communities.
yep,
I like those.
okay.
I
Oh,
think
yes,
it's a really, the downside would be they tend to be smaller unit sizes. So it might be 76 units, 100 units versus a four-story apartment building might be 400.
Right.
So smaller unit sizes, therefore fewer tenants. But
well, there's less maintenance when you're dealing with single family opposed to the multifamily
mhm,
700 units or 500
mhm,
units or whatever.
mhm. And I
So
think it,
the numbers are, I think, stronger overall because the
yeah,
tenants stay longer,
hmm
less maintenance over
hmm
time.
and it attracts a great tenant typically. You
Yes,
know, renters by choice, um, families, two incomes. They want to be near good schools. They've got pride of ownership. They just either can't or choose not to be a homeowner, but they want the look and feel of home ownership.
correct.
So yes, we're
Yeah.
seeing more of that, and I I do like it.
Hmm. Okay,
Awesome.
that
Hey, thank
answers
you
my
so much
question.
today. Really
You're
appreciate it.
welcome.
Jamie, you've
Thank you for
been
the great questions.
yeah, been a knowledge of wealth, wealth of knowledge.
Oh,
Yeah.
good.
No,
Thank you.
this was brilliant, and you're a much better presenter than I am. You know, you keep uh, your communication paced at a moderate level, and I'm kind of like all over everywhere. So
Well,
yeah,
it's normal. I mean, I know we could keep talking all day, and I appreciate your particular eye for the investment component of this. You know, this is money. Um, and you got to think about it. I think sometimes people come into a meeting with me thinking these DSTs are so abstract. And what I try to do is remind them that it's real estate and it's a real estate investment decision. And
yeah,
the same things I'll say. I'm like, well, when Joel and Mike are showing you a property, what are you looking for? How are you analyzing that? Let's take those same principles and let's apply it to DSTs because guess what? It's real estate the same
Hmm.
way you were looking at
yeah.
demographics and markets when it was a single family home. Let's do that same thing for the DST properties.
You
Right.
know, Jamie, my biggest epiphany through this whole thing is really that what Mike and I are doing with Go Be Right is I mean, it's not a DST because it's not regulated or anything else, but it provides that same value for people who are not whatever, they can be selling one property and buying two more. We just, because we're doing almost exactly the same thing. And I'd never really thought about it that we're sort of acting like DST. We're helping somebody who wants to get out of wherever they're at and move to
Hmm.
something else with
Hmm.
low hassle
Hmm.
and higher returns.
And when they
Yeah.
work with you, they get to leverage your decades of experience.
Yeah,
You've seen the good, the bad, and the ugly, and you bring that to the table when you're working with someone in
Right.
partnership with them. Like, I know you don't just boss people around and say you should buy this, but you're like, hey, here's what I've seen, here's what I know,
Hmm.
yeah. Well,
here's what you.
we take it by markets and say, hey, in this market, this
Mm-hmm.
is what performs well, and then we connect
Mm-hmm.
them with an agent that
Mm-hmm.
can connect them with that type of property in that marketplace. And so
Mm-hmm.
it's all market specific, much like yours is, well, component specific,
Mm-hmm.
but you actually have a broader wealth of offerings because we really just recommend single family homes.
Mm-hmm. 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 Yes. And I and
In
and
very
I
specific markets.
mm-hmm.
Yeah,
Very
Mm-hmm.
specific.
Mm-hmm. Which is great because like I've said, I do think for no it is unlikely a real estate investor is going to start their investment foray with me. They're going to start with you, and I think they should start with you. And they they need help. And
yeah,
I
they do.
think looking at other markets is really valuable. California is a tough place for a lot of reasons. Regulations, pricing, shrinking population. There's a lot of reasons California has become less attractive to investors. And so having a team like yours who's more of an expert on different geographies is helpful.
Yeah.
Um,
Yep.
Grateful to have you in this investment community with me and also in I know we're Sacramento based, but we work with clients nationwide, but grateful to have you in the Sacramento community as well and all the good things you do for us.